Welcome to the Nuts and Bolts of Real Estate podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how you doing today?
All good in the hood, Joe. I am blind as a bat, so I got to put my big old glasses on here. Where are you guys at? Where are you at today, Joe?
Still in Steamboat Springs. We extended our stay because it looks like they're going to get some snow on Friday night. And then after that, who knows where? Maybe Winter Park, maybe Salt Lake City somewhere. So next week should be an interesting check-in, but still at Steamboat right now.
How many days have you got in this year snowboarding?
Oh my gosh, only like 7, I think, because it was
Really?
so slow because we didn't get snow for like 6 weeks, and I am a powder queen, so I only ski powder.
Oh,
Yeah,
geez.
so got some work to do.
Funny enough, we're getting pounded here back in Washington again. You might have missed some of the Washington. Stevens Pass is getting hammered again. They actually weren't even open yesterday because of all the snow. So
We saw that. I was expecting you to cancel this because you were headed up there, but it looks like Cody is one of your faves.
That's right. Cody Davis, the famous Cody Davis, guys, is with us today. Definitely one of my faves. This is not the first time we've had Cody on the show. Joel will be dropping the previous podcast we did. Hey, Cody, what's going on?
I've been keeping busy since last time we spoke.
I guess so. So last time, October 2020, I think that's just a little bit under a year and a half ago since we first talked to Cody. He was 20. What were you, 21 at the time? With how many doors was that? I think you had 24.
20 with 24, yeah.
20 with 24 doors. And where are you at today?
Today I'm at 81 apartments at 22.
81 apartments. So in game of 57 units, how many more buildings is that you ended up buying?
I ended up buying a 6-plex shortly after we recorded. So I bought a 6, a 38, another 6-plex, and then I bought a 7-plex just outside of Seattle.
Nice. Where was the 7-plex? Did you say, was that Renton or?
That one's in Tequila.
Okay.
Just off the light rail.
So has your investors, you've been having some investors right along with you for your down payment money this entire time, or have you broken free and using your own money, or you still using other people's money? What's the story there?
Yeah, so when I first got started, I had borrowed the down payments. Since then, all of those have been paid off. So
Great.
yeah, so I've got my original 12-plex. That one's just mine today. I've got no hard money debt, and that just cash flows every month. I've got my second 12-plex. I did own that one out by myself, and I have a business partner, Christian, who I've been working a lot with. And so I let him buy into that because I found it's more fun to work on things together than it is to do it yourself. So I got a little bit of cash and paid off some other debts. And yeah, but the 7-plex is my first local building.
Have you been funding? You got, I don't know, how many buildings now? Eight?
Yeah. And so there've been different strategies because I don't want to have a whole bunch of 12% interest debt. That was a great way to get started. It's not a great business model forever, as I'm trying to de-risk some of the portfolio. And so I've started structuring things a little bit differently. Some of it I bought with my own money. The 7-plex in Tequila cost me $10,000. Everything I've bought today has still been seller finance, loan money down. So I bought the 7-plex in Tequila. It cost me $10,000 out of pocket. I bought that with my buddy Christian. And we've just done low money down payments for some of it. And for the rest, we bought the 38-plex. We did not have the money that we needed for the down payment. It was $300,000. And so we structured that. We gave up a little bit of equity in the asset with a structured buyout down the road. So we've got a 5-year window to buy people out.
Are you always doing that? Are you always structuring it with a buyout? So, you can, originally, were you always, when you were using other people's money, were you always having a buyout clause in there where you can, get on your own without having to give up your equity at some point? Or is that something you learned along the way?
Well, that's something I've added in. And the first 2 buildings I bought had really good cash flow. And so I was looking at it, okay, I could do equity or I could do debt. And equity costs more tomorrow, but it costs less today. And debt costs more today and less tomorrow because Typically, when people are partnered, they want to be bought out at a higher value. So my first 3 deals, my first 212s, and then the sixplex thereafter, I structured the down payment as debt. And afterwards, I started structuring it as equity because I had more cash flow day one. And cash flow is really helping me pay off some of the other obligations and get rid of a lot of the risk amongst the portfolio.
Gotcha. That sounds good. Let's back it up. We're going to back it up from the beginning. We're not going to reintroduce you to Cody. Well, we'll do a little mini introduction. But Joe, like we said, Cody, if you guys haven't heard about Cody Davis yet, that means you don't listen to Bigger Pockets, and maybe you don't even listen to our show. Come on, what's up with that? But you can go learn a bunch of details about the history of Cody back on our other podcast, as well as, look for, go ahead, Joe.
Yeah, it's at seattleinvestorsclub.com/129. So if you just type that into your browser, you can go and maybe stop right now, go get, all the info from Cody in the first podcast, and then come back and restart this one. Might be a good idea.
There you go, right there. But we'll back it up for a second. So Cody, give us the 10,000 foot view of your backstory for those who've never met you before, real quick. And then we'll jump into some details and nitty gritty. That's what we want to hear from you.
Yeah. So I'm a 22-year-old college dropout based out of Seattle, Washington, born and raised south of there in Tacoma. Went to college for 2 quarters, decided I wanted to get into real estate. Some person I never met before messaged me on Facebook, said I should get my license. So I decided to do that. And that led to here. Don't come from a real estate background, no family, no friends. The only person in my family lineage to ever own anything short of a house.
Nice. And so what's your why behind all this? I know you're doing this with your mom, or you got your mom on your mind in regards to all this, but tell us your why.
Yeah. So my first and foremost goal right now, I want to be able to retire my mom this year. That's why I'm doing what I'm doing. And so that's one reason that I'm taking a step back. And while I'm still buying stuff, I have a closing next week for 2 buildings. I'm not being as aggressive in that as I am taking a couple chips off the table to make sure I never have to start from ground zero again. I'm being a little bit less aggressive. And once I have a foundation of a handful of properties paid outright, like they're just owned in cash, it may be a mismanagement equity, but I can take care of my mom and know I never have to do that again. It's done. And when that's done, then I can go into expansion mode again, because I realized when I started doing this, like my why has expanded since last time we spoke. But I realized that there's a lot of people that grew up in split households like myself, where financially they're way worse off than my family was. And so I want to be a resource for them. And some of them may not even be born yet, but by the time I'm in a position to help, I can be a resource for the next generation who grew up in a split household that is not having the best financial success. And I'm not there yet, but that's...
Well, what does that mean? That means maybe lend them some money to get started?
Well, the way that I envision the portfolio growing is I'll likely be at 500 to 1,000 apartment units by the time that I'm 30. I've got 8 years, and that's without syndicating. And I figure if I'm keeping about a 35% equity position in the portfolio, I'm going to have quite a few of those owned outright. And so my thought process behind it was, I'm not just going to give them a handout. Like, I'm not going to sign over a deed to them. However, I can be the person who finances 99% seller financed to someone who's getting started. $1 million property. Hey, kid, you need $10,000. Let's go build a plan to get you to 10,000. We're going to get you in an asset. The debt payoff is going to be 20 grand a year, 30 grand a year. You're going to triple your money just on that. And it's going to cash flow, because I can structure the note like that. I don't want to give anybody a handout. They're going to get into an opportunity one day when I can afford to do that they couldn't get into otherwise, because I won't need the money at that point. And it gives them an opportunity to get something nobody's offering today.
And is that because you feel like that's the way that people have been lifting you up? Are you paying it forward, so to speak?
It would be a good way to pay it forward. If I ever find a 1% down seller finance note, that'd be phenomenal. I've yet to find that, but I just want people to know it's possible, because a lot of people think it's impossible to save up $5 grand. However, if they could see a vision to save 10 and trade it for $1 million asset, it might shift their mindset around money. And I don't think that there's enough of that out there today.
Good stuff, brother. Will be rooting for you the whole way. And I might even have some more kids just because I want them to be in the Cody Davis, who knows, school of hard knocks there. All right, well, good stuff. So let's jump into it. So basically, you've bought all your properties with no bank loans, right? And all seller financed. And have they all been on market deals, like listed properties?
So I'm closing on 6 units next week, and those are on the market. So 56 of the 87 units at that point will have been on the market.
Awesome. And so, yeah, I mean, we can talk about the busting the myths of you can't find anything on the market and it's hard to get seller financing, but that's been covered with you on those topics by Bigger Pockets and maybe in our first podcast. So go back, everybody, and listen to those. We want to jump a little further down today. People are like, how do you get the opportunity in the first place? I mean, yeah, we can learn how to finance it and do all that other stuff, but your approach to communicating with sellers or property owners, or maybe even brokers, I guess, is different. You use this, what I guess we're calling it relationship marketing, to get your opportunities. Does that sound right to you? At least that's my understanding from listening and being a fan of yours. What exactly does that mean? Instead of being somebody that's like, I'm working hard, I'm going to put in all the time, I'm going to cold call, I'm going to do whatever I need to do to talk to people. What's different, though, about the way that you're communicating with these owners? I guess we'll call it your relationship marketing style.
Yeah, so priorities matter. I prioritize the relationship over everything. And nothing matters if there's not a relationship when it comes to working with me. And so I'll give you an example. I called up a broker out of DFW, Dallas, Fort Worth, and he had a 12-plex for sale. And I wasn't calling him about the 12-plex. The 12-plex was nice. I mean, it was really nice. But I love the asset. But I also realized he works with those types of assets, and this is going to be gone before I could ever make a purchase on it. And so I called him up, and he said, hey, to be straight with you, we have a really attractive offer, and it's likely going to go under contract in the next few days. So if you're going to do anything, you need to go quickly. I said, okay, could I fly out to meet with you next month? He said, well, Cody, it's going to be gone next month. I just told you that it's going to be under contract next couple of days. I heard you. I'm not flying out to look at the property. I want to fly out and meet you. It's like, oh. And everything I do is prioritized around building a relationship. I shared a couple of my pieces over that phone call, and I just let him know I need somebody in my corner. I do ask for the lift up. I always do that. You can't get it if you don't ask for it. And so I'm asking for him to be in my corner. And I'm letting him know that I realize that he transacts with quality properties and that they're going to be gone if I don't move quickly. But I'm still willing to go fly over there and meet with them. You can do that with brokers. You can do that with owners. With owners, I'm just trying to book a meeting, and my sole intent is to learn how they got to where they're at. That's it. Most people I've found anyway, once they get to the end of their life, they don't regret what they did. They regret what they didn't do. And so they share some of the things they wish they did along the way. And they find a lot of joy out of sharing their stories. They just get a lot of, it excites them. Like, it makes them happy because they're reminiscing what they did, what they wish they did. And it gives them the heart of the teacher, right? They get to actually help the next generation out that's trying, but there's not enough people actually asking for that help right now. And eventually there's going to be a point where there's too many people calling using this strategy, and these owners won't have time for 7 coffee meetings in a day. But we're not there yet. And then it'll switch back to information-based selling, where they just send me an offer, but we're not there. Like, that's what everyone's doing today, where they're just sending all these offers, and I'm coming and asking how they did it. And I'm not asking to buy a property. I'm asking how they'd recommend I get started on the journey that they already took. And that's when they make suggestions of, well, this is how I structured this deal 0 down, or this is how I did 100% owner contract. This is how I got paid at closing. I learned from someone how you get paid at closing with an owner contract. And I'm working on an 8-plex right now in Bremerton, where I'm getting paid 75 grand at closing if and when that wraps up. And I'm going to use that for renovation. It's just, instead of the property, I prioritize learning what they did and how they did it, because at the end of their days, I mean, they can only make so much money and they can keep making more, but they want to share that with people that are intentionally trying to learn it.
That is fantastic, right? I mean, that is fantastic. And so, I mean, what, as a result of your pursuit in that, is that resulted then in deals from those people, or deals from people they introduce you to, or is it they taught you how to do something, so on when another deal presented itself, have you been able to move forward based on any of those relationships, or those that are you still talking? You still check in with all those people?
I grab coffee with them all the time. When I'm over in Central Washington, I'll go meet with them. I've met with people in Renton, Seattle, Bellevue. I mean, I've been meeting with people all over the place, Bremerton, Port Orchard. And at the end of the day, I'm not going to buy properties from a lot of them. However, the really underlying message here is that I'm meeting with these people to get confidence in knowing that there are so many ways to put these together, and it's not that difficult. That is what I've found. The more people I meet with, the more confidence I get, because they share different strategies. And that confidence carries over to other opportunities. To when I go get these on-market deals, I win because no one else is as confident as I am going in, knowing I can put those together creatively when they need something very specific out of a transaction. I can turn a transaction into a relationship, and we can work it like a circle. It just goes round and round and round. Everybody's happy.
Do you ever feel like brokers are getting in your way, or you're able, like you said, to get them invested in you as well along the way?
Brokers don't get in the way. It's another relationship to cultivate. I need them to be on the same page. I'm still a licensed agent, but a lot of my stuff is either off market or I just don't do a ton. I've helped a handful of buyers do the FHA, VA, get into 4-plexes or buy 8-plexes or 9-plexes. And while that's not the priority, I'm a licensed broker. I still let other brokers write up my stuff.
Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out, and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community. And the best part is that it's 100% free. That's right, it's free to join. So whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, BRRRR investing, flipping, multifamily or commercial coaching, whatever you like. We've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show.
Let me ask you, I want to go back to your first deal real quick, right? And I think your first deal, based on listening to the other podcasts, everybody, you'll find out, you bought, what was it, a 12 unit?
12-plex.
The 12-plex, and it had been on the market for something crazy like 560 days. Your very first deal. I always thought, what is the reason? First of all, did you have to pay the list price on that? Did you end up paying the list price on that property?
Yeah.
After 560 days, why do you think nobody else bought it? I mean, obviously you were determined. You're like, this is my way in, right? But why do you think nobody else bought that property? I'm just curious. And how did it end up going? It's going well for you, right? What was it? Why did it sit there?
I had some assumptions when I bought it that were completely off base and wrong. And I learned why they didn't sell. My assumptions, because I looked at it, I saw it never went pending. And so my thought was, oh, it never went pending. So nobody ever even got mutual. No one did an inspection. It must be fine. They just must not like the fact that it's Quincy and it's only got 7,700 people at the time. It's grown quite a bit since then. But my thought was just nobody wrote it up. I have talked with so many brokers, and a lot of the sellers that I've met with tried to buy it, and they had a difficult time working with the broker. And that, I'm going to leave it at that because all the broker stuff's public info, but they had a hard time working through the broker. And it sounded to me, based on everyone that I've talked with that tried to buy it, that they would write up terms that the other party wanted. And then the other party, the seller or the broker, would make a ton of changes. And then they go back and forth and back and forth. And they just couldn't get anything to stick. They'd mutually agree, but there was no underlying relationship to where, oh, they were just throwing those terms out. We actually want this. And the back and forth, everybody quit. People that have tried to buy my properties, I ended up meeting with them because they put unsolicited offers on some of my buildings. And they're like, I tried to buy this place in Quincy. And it's like, no way, I bought that one. So it's been fun to see that. But that was a broker relation that.
Well, how did you get through it then? You were determined and you just wrote it out to the end, or did you cave in on something or just to get going, or how did you get through it?
I didn't submit terms. I just said, how do you guys want this written up? I'm writing it up right now. I was on the computer writing it up per the broker's terms. Nothing was changed and they accepted it.
Gotcha. And so did you end up, were those terms, I mean, everybody else tried to negotiate terms a different way, maybe for a reason. I'm just giving people like insight into how you get your first deal done. I think once you get your first one done, it's just like a catalyst, right? Where you get that extra confidence. But that very first deal, again, you're back to, you kept it simple is what it sounds like, right? And you know, go ahead, you put it in your own words.
Well, folks are complicated. I got this line from my buddy Christian, and it's everything that we do when it comes to real estate acquisitions. It's how do we buy it and how do we never lose it? The how do you never lose it's based on cash flow and the length of the note. If you have a short-term note, odds are you're more susceptible to risk. But long-term notes with significant cash flow, all we have to do is figure out how to buy it. So I found a deal that I could buy. There was a private money lender, essentially hard money, that my previous mentor had an investor client who just wanted to invest in a note. And so he fronted the down payment at 12%. And it cash flowed. So I had a way to buy it, which was today the principle of how do you buy it? And then how do you never lose it, which was based on cash flow. And it's that simple. That's how I've quantified everything that I've done today. And the more that I buy, the more cash flow I get because I don't buy non-cash flowing assets. And that gives me more confidence to go do it again and again and again.
Gotcha. And so in regards to when we're talking about cash flow, you know, you're buying 12 units. Do you think you don't have an idea in your head, like I need to make X amount of cash flow per door? How do you determine like what's good enough cash flow for you? You're not using, you know, oh, I need a 10% return. I mean, what are you doing to decide whether it's, you know, 20 units or 12 units, 8 units? What's enough cash flow? It's always, for everybody, it's an individual decision, right? And maybe when you're getting started out, lots of people who think they're advanced investors might be passing on deals with, you know, $1,000 of cash flow for 12, you know, on 12 units or something like that. Do you feel that little risk factor right there is be willing to take a little bit, as long as it's cash flowing, and being willing to take a little bit less cash flow than what everybody out in investor world guru is trying to tell you should take can be the difference in you getting a deal or not, because maybe they're going to pass because it doesn't pass that accepted norm of cash flow. Tell me about that, because we're trying to get started here. I'm talking today to the people who are like you, regardless if they're 22 or 52 and they want to buy their first unit. What's the cash flow thing for you to get to when people are getting started? What do you think?
Well, I've always looked at, because I've never had a real job. I don't have a W-2. I've never had a solid W-2 to this day. I've always looked for $1,000 a month negative, or not positive. Oops, I switched those. I wanted a positive cash flow of $1,000 a month, and that was important to me because I couldn't support the negative because I didn't have a job. For folks that have a job, if you want to go house hack and you don't make any money, but you get the debt pay down, you get the appreciation, you get the tax benefits of owning multifamily real estate, and you can do it 3.5% down, that's great. But as far as my principles today, I want $1,000 a month positive cash flow. And I don't really look at the percentage cash on cash return. Some people say, oh, you should look at the percentage, but that's not the game I'm playing. I'm buying it. It's going to cash flow 4 figures a month minimum. And there's got to be upside. And I found that I can go buy 10 units, 12 units, 38 units with zero cash out of pocket. If I can raise rent $100, at least in Washington State, if I raise rent $100, I make 20 grand a door in value. And so if I can go buy a 12-plex, I make $250,000 if I find an opportunity where the rent's low.
And you're not necessarily making improvements to the units. You're just, those are under rented, and because that $1,000 a month isn't necessarily enough money to start doing big improvements to the property. You got to keep some reserve, I imagine. But I guess what I'm hearing a little bit is, let me put it to you this way. If you were going to buy you bought a 12 unit and you started off and it was cash flowing $1,000 a month, right? That's how you get started. The next one you bought, what was it? Was it also, I mean, are you like, as long as, are you ratcheting up now that you're going to want it more $1,000 a month, or you're still like, I'll take $1,000 a month and I'll go from there?
My second deal was another 12-plex. I bought that. That was a fixer-upper. Bought that seller financed as well, and that cash flowed $1,000. They, instead of $112,500 down, they wanted 120 grand down. So it was a very similar loan amount. Another investor that wanted to front that 12% interest from within the office that I was working at wanted to get into a note. And so we structured a $125,000 note to buy that. My payment to them was $1,250. My mortgage payment to the seller was $3,357, and it brought in over $7,200 a month day one. So there was utilities, there's taxes and insurance in there, but it still cash flowed over $1,000 a month. And so I didn't violate that principle. Today, I can get a little bit creative and buy stuff that is a little bit less than that has more upside, because I've got cash flow and I've got a little bit more reserves than when I started out. But that's not where people should necessarily start. People should start with what works.
Right. Well, I mean, that's what we're trying to get at here, right? Is what I'm hearing from you, Cody, is that when people go learn how to do real estate deals, and their mentors, their teachers, their gurus are telling them like, yeah, you need a 10% cash on cash return, or that's not a good deal, or even 8%. You don't listen to all that. You're like, I can work with 1,000. This is maybe why you can get a deal versus a lot of people who are going to pass on those deals, right? Because the cash flow of $1,000 a month on a 12-plex maybe isn't enough for, well, I guess, I don't know. That's what is that return on your $125,000, right?
It was a solid return.
Yeah, it is a solid return.
But it also wasn't my money. Like, that was after paying them. And so, people just got to get started with what they have access to. I've got folks that have called me outside of Jersey. I've never been to Jersey. I had a guy call me in Rhode Island. It's like, I don't know where to start. I have a duplex that I can buy off market. I use my FHA and I can get started, but that's not the 12-plex that you started with. It's like, well, does it make sense? Yeah, I'm going to live there for free. Then do it. You don't have to start where everybody who's done all this stuff, you don't have to start where they started because you're not them. You're not in Quincy in 2019. Deals don't sit on the market that long anymore because I started buying them all. Now you're competing with me if you're in that market. Nothing will last that long if it's a good deal. So you're not going to start where everyone else started. You just need to find your in. It could be a duplex. It could be a fourplex. My buddy Christian started with a condo, rented out the rooms, sold that, bought a house, and used some of the proceeds from the condo sale after years of living in it to buy a duplex. And then he bought a second duplex with a rehab loan. He fixed it up, refinanced it. It wasn't a stellar deal. I mean, his cash on cash was great because he pulled a little bit of money out, but he had 50 grand left in it that he had left over from the previous sale. And then he bought the 38 plex with me.
Nice.
We're just buying everything together. He started with a condo because it was his in to live for free. So you don't have to start with all this stuff. Forget 10%, forget the 1% rule, forget cap rate. I said cap rate doesn't matter on bigger pockets, and I mean it. You shouldn't buy.
That's what I'm getting at. Like, I'm trying to like cut out all the noise for everybody because that's essentially what you did, right? That's it. Like, what do you think after, let's say somebody, whatever the deal is, from the Cody Davis point of view, whatever anybody's deal is, like we said, within reason, you're not talking about buying 100 units and $1,000 cash flow. What do you think, if this is even possible for you to answer, that is the minimum threshold on cash flow that somebody should accept after, let's say it cash flows 10 grand a month, but have your debt, like you said, and your private money that you're paying for and whatever, after everything's paid for, however you get your money, is it $1,000 a month? That's your minimum, right?
Yeah. And if it's a smaller deal, I mean, you're not going to get that on a $50,000 house.
Understood. Right.
Most likely. Like it depends what your strategy is. If I'm looking at ratios, I like my debt service coverage ratio to be around 1.4 to 1.6.
Well, that's huge and good. Well, let's move past that. I think I'm on that. So let's talk about your initial experience when you're presenting the deals to investors, to your, second lien position or your equity partners, how you started off and screwed that all up when you were getting started, and how you're doing that different today, and any tips, or is it everybody needs to find their own way and just grind through it, mess it up and get to a point? Or do you have any advice for our, investors who are trying to get started in presenting their opportunities to people that need to lend them the money to get going?
Yeah, I would focus and prioritize getting your confidence up, and you're going to do that by simplifying the situation. I would know what your message is, meaning what do you want to be known for? I try to get known for keeping things so simple that people don't believe it's how I actually did it. I found success in that brand. Like, some people don't believe that I find all my deals right now on Google Maps. It's every property you want to buy is on that map, so I might as well start looking there. That was my thought. So when you're making these presentations, keep it simple. Know what you want to be known for. Also, prioritize being the best at just a couple things and let everyone do everything else. You don't need to be the best at everything. If you try to be, you're going to overwhelm your brain and you're going to get stuck. And then know your message at the end of the day. I don't think about anything I'm saying anymore within reason. I know what I'm doing and I know why I'm doing it. And I've done it enough times and practiced enough times to where I think more about how I'm saying things than what I'm saying. And so if you can think about how you're letting things be perceived by others versus what you're saying, you're going to be more successful. But most people prioritize gathering all this information, and it leaves you in a state where you can recite info, but you don't know why or how it works the way it does. And that's a dangerous place to be.
And tell me a little bit more, like give me an example of that a little bit more. So, I mean, obviously when you're presenting a deal to people, you got to give them some information, right? So you got to give them a little bit of information. Do you sort of say, this is the deal, and you tell them about the deal within 2 minutes, and then you go and talk about something else? Or I'm confused about your approach.
I tell a story, right? The numbers are great. I've had some people pitch me on their deals, trying to help them make their deals work. And I've helped some of them do it. And some of them I don't. And the people that I don't help out, they go straight into their numbers. This is the cash on cash. This is what our cash flow looks like. This is how much money we need to raise. This is going to be the down payment. This is going to be the monthly cost. And this is the value when it's done. It's like, okay, that's very transactional. I don't resonate with that. So I can't coach people on stuff I won't resonate with. I wouldn't be the right coach. When it comes to making the pitch, I tell a story about the property. I don't have to have all the information today. I just have to have a vision for it. This is what we're looking at. This is the location. I never compromise location ever. I've bought dumpy properties. I can fix a property. I can't fix a location on my own. So I share a little bit about that location, and then I share the vision for it. This is what I'd like to see happen. I bought a 12-plex in Moses Lake that was coined the haunted house of Moses Lake in the 90s. I mean, it was awful. It was terrible, but it's going to be one of the nicest single level apartment in Moses Lake in the next 12 to 18 months. It will be that nice. I'm getting engineered brand new roofs. It's got those butterfly roofs where water drains down the middle. And really what it does is it drains into the building. It's terrible design and old product, ugly concrete building, unpaved lot. The units have never seen love ever. I mean, they've been just refreshed maybe every 30 years. And so it's not good. I am going in there and changing that. And so when I'm able to share a vision for a property, hey, we're going to take one of the worst locations that Moses Lake is known for and make it one of the nicest. Well, now Moses Lake doesn't have any bad locations. If you're looking at a graph, if you get rid of all the downs, all you have is up, right? So if we can get rid of all the downs, now all the locations are better. Now everything is worth more and the tenants appreciate it. We're giving them a great place to stay. Investors will choose that pitch every time over someone who just shares numbers.
There you go. That's what I'm talking about, brothers and sisters. Super good stuff, right? Just completely backwards compared to what you hear every day on all these podcasting gurus and stuff like that. I really commend you. And you know what, Cody, is that it's coming from your heart too. I mean, you just have this way of, you're very genuine, right? So I appreciate that. Good stuff. So, what if somebody's not 19 and 22 years old and, has this great, cool story and somebody's buying into passing the torch on? Are you recommend that people like find their own story? Everybody's got a story. I know I've got a story. I know Joe's got a story, right? I probably don't, I never think about my story, but if I actually think about my story, it is a pretty good story, right? And I just never think about it. So do you encourage people to build that into their business, essentially, to generate, kind of same style of stuff, right?
Yeah, I'm trying to create a brand with all this stuff, but the circle and square drill are two drills that I've come up with. And the circle, I just came up with these different techniques to learn stuff. And
let's see it again.
So a circle and square, and the circle drill it's more of a connection circle. And I got that line from a buddy out of Texas because I'm not super creative when it comes to naming things. But it's basically how you connect with anybody at the highest level. And what I found is that most people know their story, they just don't know how to present it. And so I quantified this in a circle, and I drew a little circle on a piece of paper, and then I drew 3 lines outwards, and I was like, there's 3 sectors. This looks cool. And then I boiled it down to how people connect with you. And you've got your relatability section, which is your past. It's what allows people to relate with you. Relatable points. You've got your goals, where you're going. And then you've got your significance. And you'll get to the table based on your relatable points. Where you've come from, what you've worked on in the past will get you to the table with people that have done similar things. You get to connect on a basic level. And if you've got goals that are big enough that other folks resonate with, they'll work with you. And if you've got significance driving that, you don't have to sell your ideas anymore because people will just buy into who you are. So whether you're 22, 52, 72, the older you are, the more stories you're going to have. You're going to have a bigger relatability section than people in their 20s. If you've got goals, you need to meet with people that relate with you, number one, and that can resonate with those goals because they'll help lift you up. And then based on why you're doing what you're doing will determine whether people buy in to who you are. And if people buy into who you are, they will give you a lift up regardless of where you're at. But the biggest issue people have that I've had is that when I can't effectively convey why I'm doing what I'm doing, I get stuck. And so I've had to rework that multiple times, figure out, why am I really doing this? And at the end of the day, it's boiled down to family. When I first got started, my thought was, I don't have to have money if everyone pays my bills and tenants can pay, and I love cars. But that's evolved over time. It is something that really matters. And when you do that for yourself and you really think about how to connect with others based on your story, don't just know your story, but know how to present it. You can go a lot further. It's like driving in a car. You could have Siri telling you where to go. You could have Google Maps up, but guaranteed you'll get home quicker than you got to the destination because you don't really know where you're going, right? You don't know how to present it because you haven't tried. So focus on learning how to present your story, connect with people. It served me well, and it's starting to serve a lot of people that I'm sharing with.
If you're getting started, don't be in such a rush to be like, how am I going to make an offer on all these deals? Like Cody said, start meeting the people behind the deals or the brokers involved in those deals or just relating to people. Like I love the approach. It's the, we live in this world like, well, you got to do it now. I mean, the deal's going to be gone. How are you going to go that fast? And I love the approach that you're talking about of, well, I'm not talking about that deal. I'm talking about, let's talk about what's going down in the future, how I can work with you in the future, laying all the seeds in the relationship. And it's all good stuff, Cody. We didn't do a big deep dive into typical real estate, stuff today. I think what we did is a little bit more valuable, right? Is kind of turn the dial a little bit on how people are approaching this. But I will shift for a minute now, and I will say, now that we've learned all the good stuff, the meaningful stuff from you, Cody. What in the last year and a half, since you've been buying all these deals and relating with people, has been, do you think, your top two or three, because 3 is my favorite number? What have you learned? It could be like, okay, I learned that I don't want to do short-term notes at all on this, on these second loans, that could screw me really easily. Or I know I need to have more reserves going in, or I know that I don't want to buy a property that has plumbing that's this old or something like that. What are your top 3 things you think in the last year and a half since you got started that you've learned? Because nobody's perfect here, even though you're a superstar, but we know that we fail forward.
I've had so many learning mistakes. It's been ridiculous.
Yeah. Give us a couple good ones.
So the thing that like Bigger Pockets doesn't see and YouTube doesn't see and all that.
Hey, that's what we're going to Seattle Investors Club. That's what we want to see.
Yeah, this is where we share all the juicy details.
That's right.
So I got started, and I mentioned that there was a person in the office who had an investor who wanted to put their money in a note. And this person connected me. They helped. I had to make the pitches, and I failed some of those pitches originally getting started. I mentioned that on your previous podcast. But they said, hey, look, Cody, if you want to do this by yourself, you can do it. Or I can be an equity partner and I can make sure that you miss a few pitfalls. And so I said, yes. The person who loaned the money was not a partner, but the person who made the connection, he was genuine at the time. And he said, if you want, you can do this on your own. No different. Or we can do it together and I'll help you avoid some pitfalls. And he helped me avoid a lot of pitfalls. But what I learned in the process after we recorded is that not all partnerships go very well down the road, and that intentions change and values didn't align. And that transaction, the fact that we ended up, the relationship turned sour relatively quickly. I inherited about $350,000 of debt. I had to cash out about $125,000 in additional to get out of that partnership, and lost about 77 grand from my cash accounts that were shared. So that was about $500,000 ouchie. I got the properties in exchange. I got, he was out of the properties. It was just the 212s. I started buying everything after that, just me. But I got rid of him, got it cashed out, and I could not be where I'm at today had I not learned some of the other pitfalls from him. But partnerships can be expensive if you're at different stages in life. I like to think of it like the life cycle. Everybody's at different points. And it's kind of like, I've never been married, but I imagine it's kind of like a marriage. It's a big commitment if you're doing bigger deals. And so it's something to think about. And I had to learn that the hard way. But
how would you approach that? Are you saying that you don't want partners in the future because or you need to vet your partners a little bit closer to make sure bigger picture stuff is aligned?
My learning lesson from that is I need to get big enough to where that can't impact me. That is it. I let Christian, my business partner, buy into some of my stuff. He's buying into the 6plex. He already bought into the 12. I let him buy into that so I could get a little bit liquid. And I know that may go wrong. And if it goes wrong, it's going to be a whole lot of fun. But I still have some of my stuff. I have my very first asset that's my own, a 12plex. And everything else could go wrong. And I know that willingly. However, I have enough trust and confidence based on working with him that even if something goes wrong, we are expanding at a rate that will be big enough to where $500,000, $1 million, $2 million potential loss will not affect us when we're done.
So are you not able to use partnership agreements that are a little better written or stronger to overcome some of these bad experiences, that you can incorporate those scenarios into partnership agreements?
Oh yeah. So I've started using my own attorney. When I first got started, I used his and I didn't read it or review it. I just signed it. Oops. And that's okay. The relationship was there at the time, but it's definitely a learning lesson. You should have your own representation to review that stuff. It seems comical looking back on it now that I didn't have it reviewed, but hey, I was getting started. Everybody starts at zero.
So maybe the lesson there is, even if you're getting started, somehow muster up the $500 you need for an attorney to review whatever you're going to sign partnership wise, but I don't know, like you said, some people are going to be willing to take the risk just to get started, right? You just fail forward, I guess. But well, that's one.
Maybe don't start with a partner. If you have a job and you qualify for traditional financing, I wish I did. Today, with 81 apartment units, I still didn't qualify. I just don't. And a lot of lenders don't like the fact that I'm scaling at the rate I am, because based on my earned income, I shouldn't be able to buy these assets without syndicating. And I'm not doing that. So they're just like, I don't understand what you're doing. And so lenders are getting a little bit skittish at that. If I could find a lender who would qualify me, that would be wonderful. Maybe we can find one through here.
Yeah, maybe we can. We'll be on the lookout for you.
If you qualify for traditional, buy your first building by yourself. It's not that hard if you have stable income for an extended period of time and you can save up to 3.5%. As long as you can do that, depending on where you live. I mean, if we're talking just Seattle, I don't know how far your reach goes, but if you're looking in Tacoma and you can get a duplex for $500,000, you just got to save up $17,500 plus closing costs, and you're off to the races. So you just got to do the math, build up the reserves, and you don't need to go start, like we mentioned, on a 12plex. You can start with a duplex. You can start with a house with an ADU. There's so many ways to do it.
We're talking about occupying that for that 3.5. Yep. You got to live there, right?
Find your way in. Yeah.
There you go. All right. Well, that's a good one. What else? What else you got? We got about not that long left, but what else in the last year and a half? Lessons learned.
I have to audit contractors. I did a contractor audit and saw that they spent 406 hours on a 600 square foot space where they didn't even redo floors. And that made me scratch my head.
So if you take your eye off them, they'll take advantage of the situation with their hours.
And it may not be that they're like the GC is just taking advantage, but it might be that if they're working on multiple units at one site, they may be double logging and the GC may not know. There's not always malintent, but it's something you have to watch, because the labor cost on that, I haven't paid them yet because we're sitting down this week. Like, this happened within the last week that I did this audit. The labor cost was 65%, which seemed very high for a renovation. So you got to watch your numbers. You can't get a little bit laid back just because things are cash flowing. Just because you have a bunch of money coming in doesn't mean you can get relaxed. You need to stay hyper focused on the little things, because things will get through the cracks.
I know one of the biggest investors, big flipper in town that I've worked with for years. That was happening where even somebody extremely experienced doing 50 deals a year or whatever, is having had the same problem. I've been in deals and with that person before and be like, what's the story on why was this so expensive? Why did it cost so much? Come to find out that it was all these extra hours running away from him, not maybe not having the project manager, overseeing that a little bit, but, a little trick that I used to do on big, 200 unit apartment buildings where I'm hiring, contractors to do big things and stuff like that. I would play stupid and they would give a bid and it would be a lump sum bid. And they'd give me the bid for whatever, big electrical renovation in a bunch of units or whatever it might be. It could be anything. And they give me a bid and they'd give it in a lump sum. And I'd say, oh, okay. And, sure, give me the bid. And I would act stupid. Like, how many guys are you going to have out here? So I know how long, I know what's going on. Do you think you're going to have like 2 guys on site or 3 guys or whatever? Kind of casually just chatting them up. Okay, well, is it going to take you guys a week or what? I mean, how long, just not relating it to the bill, but just sort of playing stupid, like how many people, how long, about blah, blah, blah. And then they come and give me the lump sum bid after they've told me 3 guys will be here about a week, right? And then they give me the bid and then I give it back to them. I say, can you break it down between labor and materials? Break down the bid between labor and materials. And that was my audit. And I'd say, wait a minute, you just told me you're going to have 3 guys here for 5 days. You're charging me $700 an hour for this labor number, right? So totally worked every single time. That's my little tip to you guys. Play stupid. How many guys you're going to be able to have on crew. So I know kind of about when it's going to get done. You're going to be here, 3 days, 2 days? Oh, we're going to be here 5 days, 3 guys. Okay, great. And then just go back and nail them with it. Breaking down and if they won't break it down for you, materials are not that much, when it comes to these sort of things necessarily. So you can audit that as you go. So that is also a good one. Happens to even super experienced people. All right, one more, and then we're going to hang it up here.
Okay. One of my learning lessons doing everything is that everything costs more than you think it's going to be. I mean, everybody says that. So I guess I'll just throw on one more. Just because it makes money doesn't mean it makes sense. That's it. I mean, that's probably my biggest learning lesson. And that's what I share with folks. Just because it makes money doesn't mean it makes sense. And it's easy to get distracted with different ideas. I've got friends making money with NFTs and cryptos. And like, what's your long-term goal? Well, I want cash flow. Well, is this going to get you cash flow? Well, as soon as this goes up, I'm just going to put it into real estate. Okay, well, why not just go buy real estate? I can't qualify. Get a little creative. Start with the thing that has the most potential upside that aligns with your goals. And so while there's these other opportunities that could make me money and that would make me money, it doesn't mean it makes sense for where I am looking to go.
Stay focused on your goals, right? Without the shiny objects in the middle. That's a good one. That's a tough one for people to learn, right? Is the whole staying focused on the end goal there. Well, super good stuff. So what do you need, Cody? What is it? Right now, you said you need a lender, and you need a lender that'll finance you because they're worried about how many seconds you have, or how much your loan to value is too high. What's the story? For all you lenders listening, this is your opportunity to get in.
I have only 1 second mortgage, and I'm paying that off in the next 45 days. So my loan to values are around 60 to 65% for the majority of the assets. I bought some.
That seems bankable. So what's the issue?
My issue is that I don't have any income. While I have 5-figure cash flow, everything is rolled back into improvements. It's like a switch, build. And one day when there's 100,000 a month or something ridiculous in cash flow, I'll just flip the switch. It's like, okay, I can't improve granite anymore. It's done. So right now I don't pay myself anything, but I've got assets with equity and I don't have a real job. So I have yet to find a lender who, while they want to help, I haven't found someone who can get my situation financed.
Gotcha. And it's because It's because of your income, or they're not counting your cash flow. I guess cash flow is not necessarily counted as your income. It's hard to understand a little bit on what it is to me, why they're not like commercial lender.
Oh, I'm talking about like I'd love to buy a house.
Oh, gotcha. Okay, that's different. Okay.
Yeah. I want to buy a residential place, and I haven't figured out. I could probably figure out the seller finance thing, but I haven't gone down that route. I'd like to do conventional 30-year debt.
Gotcha. Well, there you go. You need some help with that. I understand that. Well, if you're listening and you can help Cody, there you go. Help him out. We'll keep our ears peeled for you. Anything else that we can help you with, Cody, while we have you, or put the word out for you?
No, that's okay. I was glad that we got to catch up again. It's been a long year and a half, and it's fun to reconvene.
Yeah. And are you looking to do deals? Are you cool with out of state, or are you trying to stick in state? What's up with you there?
Yeah, I am looking out of state, and I am likely going to scale up out of state. I'm thinking about a couple different options right now on whether I sell what I've done in 1031 into something massive, or if I keep it and then just keep buying and do that later. There's all these different ideas that are going through my head, but I'm actively looking at expanding outwards. I try not to focus on too many different ideas, because then nothing gets done effectively. And so I'm going to keep doing what I'm doing for now. And then likely in the next 6 months or so, I'll start venturing outwards.
Yeah. I mean, the tough part about the 1031 is timing, right? Finding something to buy and being able to get something sold within the timelines. Almost, if you can reverse engineer it, better, have it all lined up, right? There you go. Well, good stuff. Good stuff. All right, Joe. Well, we've come to the end of our journey today. We're all going to get back to doing our thing. Where can everybody find the details of today's podcast?
Yeah, you can get to all the details by going to seattleinvestorsclub.com/159. And if you guys like this, we'd love any kind of thumbs up or shares or anything else. And one question is, where can people find you, Cody, and your stuff that you're producing?
Yeah, so online, I'm on Instagram. It's Cody D 2020. And I started a YouTube channel, which is smaller. We've got about 2,500 people on there. But that's Cody and Christian Multifamily Strategy.
Cool. Awesome. We'll check it out. Is that Christian Harris?
No, Christian Osgood.
Gotcha. Okay, cool. Excellent. We'll check it out. We'll drop a link to it in our show as well, if that's cool with Joe. And we need to check in with you in another year. Hopefully we're going to talk to you obviously before then, but we're going to just have you back on as you grow. It's a fun journey to watch. Super fun. And we wish you the best
great.
luck. You don't need us to wish you luck, but
I will take every little bit I can.
Sounds good, Cody. Congratulations on your success up to this point, and keep on trucking, brother.
Thanks, Julie.
All right, guys. If you would like to join us, don't forget, every Thursday, you can join us at our weekly mastermind virtual meetup here on Zoom. Every Thursday from 11:30 to 12:30 Pacific time. We have people that join us from out of state, California peeps, sometimes New Jersey and some other places. Join the conversation. It's a good time. And if you want to get access, we actually record all those weekly meetups where we drop massive nuggets and share deals and all kinds of stuff. It's, like I say, it amazes me to this day how good it actually is, and how much you'd think I'd be bored, but it is good every single week. And if you want access to all those recordings, you can become a member of Seattle Investors Club for $220 a year, and those are all available to you. Or you can just show up for free and join us on the live meeting, and we'd love to see you there. Come and listen, or come join to be part of the conversation. Yes, you're missing out. I'm not afraid to say it. I'm proud to say it. You are missing out by not showing up and checking it out. So hope to see you there. Bam, bam, on a Thursday. Over and out.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.